Good morning. Welcome to E-mini Futures by Sell.com. This is Balasubramanian Iyer welcoming you on 15th of October 2017, 11:30 in the morning. Now, in this video, we're going to talk about portfolio building. So, what is it, and why do portfolio approach to position building or portfolio method to trade. So whether you are a day trader, swing trader, position trader, macro trader, investing for your 401k or RRSP or TFSA, RESP, for everything you need to have portfolio approach where you build a position and rebalance your portfolio. This applies even in day trading, and this concept or principle has been scientifically tested and is well accepted, is part of academic theory, and many Nobel Prize winners have got Nobel Prizes because of this theory. I mean, they are the ones who came out with this idea. So it's not that something new I'm dishing it out, okay? So it's a well-known, proven academic concept, but unfortunately or tragically, many traders are unaware of this idea or concept, and they resort more to gambling than a portfolio approach. So I'm trying to make through this video people aware of this well established academic theory, and which will help you in long term success. Now, this concept of portfolio approach and building a position, it also works in futures, a standard lot. The only problem is you need a big account. You need a lot of money, which is why we recommend do it with mini lot or micro lot or CFDs or spread betting. The concept itself is applicable to stocks, ETFs, bond trading, to all types of thing. It's not that you can do it with futures. You can, but then do you have a large account? And also there is a psychology when the market goes against you. Can you handle the roller coaster? There is an emotional aspect to this, which is why we recommend do this portfolio approach of building a position in mini lot is much easier to do, okay, from a psychology perspective and also from a financial perspective, okay. The second thing is markets by nature, all the financial markets are non-linear. What does it mean? It means that they never go up in a straight line or go down in a straight line. So almost 95 to 19, I would even say 99% of the time, when you put a trade, say you go long oil or you go short gold or any trade, you must always expect that the trade will go against you. Meaning after a few hours or the next day, you're going to see that you're down. This is natural, this is very common, and you should accept it. And not just accept it. If you just accept it and do nothing, you're being passive. So what we are recommending is this non-linearity of financial markets. Is there a smart way to exploit that to your advantage? And that's what we're going to teach you or tell you or suggest to you or recommend to you. We want to suggest or recommend an approach which is been proven and established by Nobel Prize winners and is part of academic theory and is taught in all Ivy League classes, is how you use a portfolio approach and position building to exploit the non-linearity of financial markets. So what we are suggesting is you start with a very small position. So for example, recently in our signal, I have recommended to go along the futures, S&P, Dow Jones, Nasdaq, or even say crude oil buy or whatever trades you're doing. Okay, what we are saying is start with a small position in, say, in the case of mini lots, and be prepared or expect markets to go against you. So let's say you start with point 0.1, and then when it has a significant correction, you add another size, say another point 0.1. So now you're long, assuming it's a long trade, you're long point 0.2 of that market. And if it has another correction, you add another 0.05, then you are 0.25 long of that position or market. The same logic applies if you're going short. So this way you are, you are bringing down your average cost. Okay, that's one thing. Second, you are going with the natural flow of the market, which is markets are non-linear. So building a position makes a lot of logical sense. The second approach is the stop loss. As long the question is how long do you keep doing this, building a position, as long as your stop loss is not hit, or we, the signal provider, we send out an Excel file or email or through WhatsApp canceling the signal. Until these two events happen, you should keep building your position. Okay, that's very important. Second principle of portfolio approach is to have diversified portfolio, meaning you should have assets which are uncorrelated or not correlated with each other. So typically traders go long euro US dollar or go short GBP JPY, things like that. That's not how you do it. If you have a portfolio, because no matter what you do, you can never predict the market. The market will always prove you wrong with unexpected movements. So the way you exploit this to your advantage is you mix it up. Okay, don't put all your the old grandma's wisdom, don't put all your eggs in one basket. So what you do is you say, let's say you're long oil, short gold, long ES, short bond, long euro GBP, short AUD. You're mixing it up. Your different markets, your different positions. Some are long, some are short. Then you kind of get an hedge, and then you focus on the portfolio return. Don't focus on the individual return. Don't see whether you are in profit in euro or you're in loss in oil. Not like that. Look at your bottom line at the portfolio. Is the portfolio making money? And because you have mixed it up, like you put all the different markets together, you get a natural edge. And what will happen, the way portfolio makes money is, let's say some of the markets where you're losing, but you're not losing big. They're kind of going sideways. But the market you're winning, which is in your portfolio, you're winning big. So even though you have, let's say you've got five positions, five different markets, three are losing, so you're down, but two are winning. But if those two which are winning big, and those three which are losing small, your portfolio will win. You will have a bottom line. Your portfolio will be a healthy plus. So that's how you win. This is the basic concept. Mix it up. The only problem with this approach is you need a large. If you're going to do it in futures, you need a large account. Even if you're doing in mini lot, and if you've got, let's say, five positions in five different markets, you can do standard lot for two reasons. One, you need a big account size, and second is the emotional roller coaster. When you're down with standard lot, you'll be down $1,000 or $500. You can't handle it. So which is why we're saying build small position, that way you can spread it around, then you will come out as a winner. Practice this method, get comfortable. Once you see that this is working for you, this is winning for you, then you can start going for half of standard lot. Like if you're doing mini lot, every position will be 50% of standard lot. But to get there, you need to work towards it. Don't do everything on one day. Okay, so that's very important. The second thing we wanted to highlight is the type of mistakes many traders are doing, and I hope and I would like to highlight this so that you don't do it. See, for example, USD CAD is a good example. We had a very good trade in USD CAD, but this so far in October we haven't. In the last week we haven't given a trade on USD CAD. I've seen many traders who have jumped into USD CAD and have tried to short it or do something. But look at the illogical irrationality of it. Bank of Canada is going to have a rate decision on the 25th of October, and that's a big move. So think through logically between now and 25th of October in 10 days. Do you think that the players who have large sums of money, the big guys, are they going to step in and take a position in USD CAD one way or the other, meaning go long or go short? They will not. Why would they do? Because especially the Bank of Canada governor is an unpredictable, eccentric guy, and he always shocks the market. So nobody will take a position in this currency pair until the dark clouds are cleared. So one logically one should not trade this currency pair, but a lot of traders do it. Why do they do it? Because they are a gambler. 90% of the traders are controlled by emotion, not by logic. So when they are controlled by emotion, even though they are intelligent, they end up gambling. The gambling instinct is a dominating instinct in most of the human beings. So you have to decide if you want to be a gambler or a person who thinks with logic. Your decisions should be based on logic. So that's my 2 cents for the day. And similarly, Aussie dollar and New Zealand dollar, you can see there is a CPI key data coming in. New Zealand dollar tomorrow, Aussie dollar policy minutes are coming, Aussie dollar, unemployment. These are, so why would I take a position on AUD or New Zealand now? I wouldn't, right? And same with euro. Draghi gave a talk, and Draghi gave a wishy-washy, goosey-goosey talk about euro. So, but basically, he was trying to talk down the euro. So we have to see how the traders react to that in the coming week. I was tempted to go long euro, but given this goosey talk from Draghi on euro, traders can come and short the euro Monday, Tuesday. It could well happen. So what I'm trying to highlight is be aware of the fundamental. Don't only focus on the technicals. Marry the two and try to be logical in your trading and in your approach. And again, to go back to portfolio approach, build your position. Start with a small size, gradually build your and add to a position when the market goes against you. Now, should you be adding to your position when the trade is in your favor? That is, you put a trade and the trade just takes off. Generally, it's not a good idea, but you could do it. I mean, there are times, there are situations you can do it, but just be aware 95% of the time markets will go against you, meaning you put up trade and very rare it just goes up in a straight line and you are laughing your way to the bank, or it goes down in a straight line if you're short and you're making money, crazy money. That happens only 5% of the time. So what you should have a strategy in your bag, in your toolkit, is a tactic which will work 95% of the time. Okay, so that's the basic theory. Mix it up, have a diversified portfolio. Don't put all your eggs in one basket. And start with a small position and build your position. Okay, be good at it, and start with even zero point 0.05, zero point 0.02 is fine because you're learning a skill here. This is not about making money. Once you get good at it, later on you can start with zero point 0.3, you can start with zero point 0.5, you can up it up. So you can build it up even further, but you have to get there. It's a process, it's a journey. Don't go all in, bang bang bang. That never works. Okay, that's my purpose of this video. Again, exploit the non-linearity of the financial markets. Markets are non-linear by nature. Have a diversified portfolio, uncorrelated assets. Build your position. Small position, add when it pulls back. Add when it pulls back. That's how you do it. God bless you all. Bye for now.